more than 6 months ago. Bloomberg data shows 4 Singapore companies have the highest odds of failing to meet their debt obligations. Singapore's bond market has seen rising defaults and a slump in oil prices, along with a weak property market. The Bloomberg data showed the 4 Singapore firms have a 1.44% to 7.27% chance of falling into a default. 2 Singapore real estate developers, TA Corp and T Land, are among the firms highlighted. TA Corp posted a net loss of $6.7 million last year, its second straight year of losses, while T Land saw its net income slump 95% from a year earlier to $66,000 for its third quarter. Other troubled companies highlighted by Bloomberg include oil-related firm Pacific Radiance and Falcon Energy Group. Well, as for the Singapore markets, shares rebounded on bargain buying after 2 consecutive sessions of losses. The benchmark Straits Times Index is up 11 points at 3,246. And for more on this, I have on the line Gabriel Yap, Executive Chairman at GCP Global. Now, Gabriel, tell us, how will the UK election result affect the Singapore stock market?
Well, I think the impact would actually be very much concentrated at the macro level. I think essentially what the market is experiencing is rather more positive news, which actually have helped the market up to its current level. The only thing is that the recent high that was notched up in May at 3275 on the index would likely to be challenged, probably only later half the year, because going between now to the summer lull, it is apparently quite clear that most of the funds are shifting out of the Singapore market as opposed to shifting in.
All right. We have also just heard that Bloomberg has highlighted 4 Singapore firms which are at risk of defaulting on their bonds. Should investors tread with caution with regards to the Singapore bond market?
Oh, yes, certainly so. Since the demise of Ezra and Swiber, as well as other oil-related bond issues, it is quite clear that bond investors in Singapore are, number one, not very sophisticated. 2, are actually very risk-preferred when it comes to their choice of bonds, which is quite surprising considering the fact that most are conservative. In fact, you look at all the 4 bonds that I've actually mentioned, the 2 marine bonds, including Pacific Radiance, the 2 property bonds, that's basically T Land as well as TA Corp. It is quite clear that the total debt liabilities is almost 3 to 4 times the amount of total equity in the company. This would easily mean that these companies would be really vulnerable if there is a sudden change in cost of capital. This would also mean that essentially if at any time the banks push to actually call up the loans, then this company bonds would probably be very, very vulnerable.
And finally, what's your outlook on Singapore REITs and property-related stocks? Are they looking expensive at the moment?
I would say they're looking fairly valued. I think the Singapore property counters have actually run up quite a fair bit, in the region of 25 to 30% since the beginning of the year. This is latching on to the fact that the property sales, particularly new property projects in the Pali Baku area, as well as in the east area, have actually seen better than expected sales. But I would like to caution that having higher transaction volume does not necessarily mean that the recovery in the market is in place, because developers can easily sell more units by lowering their per square foot cost, which is basically what is happening. I think I would suggest that it will probably take a little longer for the market to play out whether the recovery is very much in place. With respect to REITs, the REITs have done very well since we highlighted them in our various investment classes since the end of last year. I think having run up like 20-30%, I think it's only quite wise for you to be more selective at this juncture. Take profits on those that have run up substantially and look to reposition those which have actually not run up, where the fundamentals are strong, where the gearing is actually acceptable, and where there's positive reversionary income in the leases of the underlying leases of the REITs. And that's where you get good organic growth to support the valuations.
All right, many thanks for your insights, Gabriel.